Let me ask you something. What if a single accounting change in 2026 could either unlock millions in funding for your company or get you a qualified audit opinion that kills your M&A deal? Well, that's exactly what's on the table. If you're a business leader in Turkey, especially in the tech or export sectors, you absolutely need to understand the upcoming IFRS shift. So let's break down what you need to know right now.
So really, is your business ready? Because this is not just about ticking some compliance box. This is about whether you can secure that next big round of funding. It's about whether your company's valuation actually holds up under scrutiny, and frankly, whether you can even get a clean audit report. The stakes are incredibly high, so let's get you prepared.
We've got a clear roadmap for you today. First, we'll cover what's changing. Then, we'll dive into the key differences that are going to impact your bottom line. We'll map out a transition plan, and then look at the risks versus the rewards. By the end of this, you'll know exactly what you need to do to come out ahead.
All right, let's get right into it. What exactly is this shift? And, why is it happening now? It really all comes down to one thing: Turkey's growing presence on the global stage. Let's break that down.
Okay, first things first, let's get the terminology straight. You're going to hear the acronym TFRS a lot. It stands for Turkish Financial Reporting Standards. But honestly, all you really need to know is that it's Turkey's official adoption of IFRS, the global gold standard for financial reporting. And this isn't a suggestion, it is a hard requirement.
Now this gets right to the heart of the challenge. For years, you've probably been running your books according to the tax procedure law, right? We call it VUC. It's all about making sure you're compliant with the tax authorities. But now, you have to run a second set of books under TFRS, which is all about showing investors the true financial health of your business. It's literally like speaking two different languages, and trust me, the translation is not always one-to-one.
So who does this apply to? Well, if your company crosses two of these three thresholds, assets, revenue, or employees, for 2 years in a row, you're in. And with the recent boom in the tech and export sectors, we are talking about a massive number of companies that are about to fall under these new rules for the very first time. If you think that might be you really need to be paying attention.
Okay, now for the really interesting part. How do these new rules actually change the story your financials tell? Because this isn't just about crunching numbers. It's about how you present your company's value to the entire world. This is a perfect example of how different things will be. Under the old rules, you sent an invoice, you booked the revenue. Simple, right? But with IFRS 15, it's all about when you actually deliver the value. So if you're a SaaS company with an annual subscription, you can't just book that whole year's revenue on day one. Nope. You have to recognize it month by month. And that simple change can have a massive impact on your reported growth.
Here's another absolute game changer. That office lease you've been paying for years? It's no longer just a monthly expense. Under IFRS 16, it is now an asset and a liability right there on your balance sheet. Now, the interesting thing is, this can actually make your EBITDA look better. But, and it's a big but, it also increases your reported debt, which could have serious implications for your existing bank loans and covenants.
IFRS 9 is all about being proactive with risk. You can't just wait for a customer to officially stop paying you anymore. Now, you have to predict who might not pay you in the future and account for it ahead of time. This means you need a solid model for forecasting potential bad debt, and you can absolutely bet your auditors will be taking a very, very close look at how you came up with those numbers.
Now, all of these little differences between your tax books and your new IFRS books, they create something called temporary differences. Think of it this way. Your tax books might say you made a certain amount of profit while your IFRS books say something else. Well, you have to account for the future tax impact of that gap. It's a really complex calculation, and honestly, getting it wrong is one of the biggest red flags for auditors.
Okay, so that's the challenge. And I know, it might feel like a lot to take in, but it is completely manageable if you have the right plan. So let's talk about the solution. Here's how you can navigate this transition and actually come out stronger on the other side.
The good news is there is a clear 4-step process for making this happen. First, you'll lock in your transition date. Then, you'll create a brand new IFRS-compliant opening balance sheet. Next, you'll actually get to take advantage of some built-in exemptions to simplify things. And finally, you'll create a reconciliation that clearly explains all the changes from the old system to the new one. So, how much time do you really need to budget for all this? Well, as you can see, it really depends on the size and complexity of your business. For a smaller company, you're probably looking at about 2 months. But for those mid-sized tech and export firms we've been talking about, you'll want to set aside at least 2 to 3 months, maybe more. The bottom line is this: the sooner you start, the better.
And hey, if you're a Turkish subsidiary of a larger international company, the pressure is really on. Your parent company is almost certainly already on IFRS, and they're going to expect you to deliver clean, audit-ready IFRS reports every single month. There is absolutely no room for error here. Getting this right is essential for the entire group's financial reporting.
This whole transition really comes down to a choice. You can see it as a compliance headache, a chore you just have to get through, or you can see it as a strategic opportunity to level up your financial reporting and unlock some serious value. Let's look at both sides of that coin.
Let's start with the risks. If you're not prepared, these are the exact things your auditors are going to find. And any one of them can lead to what's called a qualified audit opinion. What does that mean in the real world? It means your M&A deal could fall through, your funding could be put on hold, and your company's reputation could take a serious hit.
But what if you get it right? Well, the upside is huge. Suddenly, you're speaking the same financial language as the rest of the world. That means more investor confidence, much smoother audits, and a higher valuation when it comes time to sell or raise capital. It's a clear signal to the market that you are a serious global player.
So let's bring it all home. How do you make sure you're on the right path? How do you capture all of those amazing benefits while avoiding all the pitfalls we just talked about?
This quote really just hits the nail on the head. This isn't just about accounting. It's about building a world-class financial infrastructure that's going to support your company's growth for years and years to come. It's about getting your business ready for the global stage.
The bottom line is this. If you are a growing tech company, an exporter, or if you have any plans for investment or an M&A deal on the horizon, you need to get ahead of this now. Proactive IFRS readiness isn't just a good idea, it is absolutely essential for maximizing your company's value.
Look, this is a complex transition, there's no doubt about it, but the rewards are well worth the effort. The key is to have a clear strategy and the right expertise to guide you through the process. If you want to make sure your business is ready for 2026 and beyond, we're here to help. Reach out to us at info@ozmconsultancy.com and let's get you prepared for success.